The West is becoming more like, with its lax monetary policies, credit direction by the state, so forth, it's becoming more like the traditional developing markets, whereas some of the emerging markets are showing a much sounder monetary policy.
Welcome back to Breakout with Breaking Views, brought to you once again by Pidgin. I'm Peter Thalassen, the global editor of Breaking Views in Canary Wharf in London, and I'm talking to Edward Chancellor. This week, we are talking about escaping inflation. Prices are soaring, but interest rates, at least in the developed world, are lagging well behind. And that means that investors' assets are being eroded. This is a situation we haven't really seen in the West since the 1970s. So Eddie, what are the lessons from that period? And I guess what can investors do to preserve the value of their money?
So what we call financial repression, which we've talked about before, is interest rates being kept below the rate of inflation, with the idea that if you keep interest rates low, the stock of debt that is built up will gradually be paid away. It's a nice idea, but someone has to pay for it, and namely savers who have cash or own bonds in countries with financial repression tend to pay the cost, the inflation tax. Now, in the 70s, what you find, and this is completely unsurprising, is that countries with the lowest levels of inflation, their currencies tended to perform much better than those with high inflation. So ideally, investors should, if you had perfect foresight, take your money from countries with high inflation, put it in countries with low inflation. And in the 1970s, that meant putting your money in Swiss francs or in Deutschmark, and that provided, if you particularly, sterling was a very weak currency in the 70s up to the IMF bailout in 76. So if you were a British investor, putting your money in a Swiss bank turned out to be a good move.
These are the safe havens that people talk about, I suppose, right? The people rush to sort of somewhere where you can hope to preserve your capital.
Yeah, no, I'm saying we see the same thing going on today. So Switzerland has relatively low inflation compared to much of the rest of the developed world, and its currency has been soaring this year, relatively strong on the exchanges. And even the dollar, which has, as we know, pretty high inflation and whose interest rates are very low, has been doing pretty well relative to, say, sterling, which is once again a bit of a basket case. My argument is that can only go so far, because the trouble is that both the Swiss franc and the dollar are pretty expensive currencies to start with. We often cite the Economist's Big Mac index, how much it costs you to buy a hamburger in one country relative to another, as a sort of proxy for purchasing power parity or fair value of the currency. Now, at the beginning of this year, when the Economist published that data, you find that Switzerland was most expensive place to buy a hamburger, and the US was the third most expensive place. So now, what we know from history is that once currencies become massively overvalued, their central banks or monetary authorities tend to intervene to weaken the currency. Now, the great example of that is the Plaza Accord of 1985, when the US basically bullied other countries into appreciating their currencies to bring down the value of the dollar. And it's conceivable that we're getting quite close to that moment where the dollar is looking too strong, because as you know, if you look at the current account balance in the US, the deficit is gaping up. And Switzerland in the last decade spent most of its time, as you know, printing money to buy foreign assets in order to sell the Swiss francs, in order to keep the franc low relative to the euro. So I think that pressure will come back in time. And I wouldn't say that the Swiss franc may be a relatively good safe haven. The US looks less good. Not only does the US have a great pile of debts, but as we keep on saying, its monetary policy remains remarkably lax.
So the traditional safe havens don't really work this time. Or they're overpriced perhaps. So where do you go instead? You have this great line in the piece where you talk about your investors need the least dirty shirt. Then that's what they need to try on. So
yes,
the least dirty garment that you can find in this world.
No fiat currency is perfect. I'm suggesting two alternatives. Firstly, looking at Japan. Now, the Japanese currency has depreciated by nearly 13% this year relative to the dollar. The Japanese currency is pretty cheap. It's fallen by 50% in real terms, in trade-weighted yen, since 1995. And the inflation in Japan is still relatively muted, only at around 2%, in line with the BOJ's target. And therefore, real interest rates, which are the ones that really matter, interest rates after inflation, are actually much less negative in Japan than they are in the United States. So I can see, given that the cheapness of the yen, I can see that you could have a turnaround, and the yen could easily start appreciating relative to these other currencies. However, I also point out the yen is not really a perfect safe haven, because, as we all know, Japan has the highest levels of public debt in the world at over 230% of GDP. And what this means is that when inflation comes to Japan, the central bank will be constrained in raising rates, because you basically would have a fiscal crisis. So we think that sooner or later Japan will end up in the financial repression camp. So it may be a sort of reasonable short-term or medium-term trade. I often advocate it from an equity perspective, but not necessarily from a cash holding.
I mean, you're talking about emerging markets currencies possibly being the best alternative, which is quite a contrarian view.
It is a contrarian view. It was told to me by an emerging market debt friend of mine. So he had something to sell. But the thesis is this: is that financial repression started. The term was actually used to coin the poor monetary policies in the developing world in the 1970s, and now I'm saying that we're sort of trading places. The West is becoming more like, with its lax monetary policies, credit direction by the state, so forth, it's becoming more like the traditional developing markets, whereas not all, but some of the emerging markets are showing a much sounder monetary policy. And I cite, for instance, the case of Brazil, whose interest rates have gone from 2% last year up to nearly 13% today. And that's slightly above the rate of inflation. But if you look, another way of looking at it is if you take a basket of the big emerging market borrowers of Brazil, Indonesia, Mexico, and South Africa, and look at the real rates on their bonds and the gap between the real rates on their bonds and those on US, the real rates on US 10-year bonds, that spread there is about sort of 7.5 percentage points. It's the largest it's been for 15 years. It was actually a bit earlier this year, up at 10 percentage points. So you're getting a real yield differential between emerging and the developed world. And I'm also saying that these currencies are relatively cheap, therefore they can afford to appreciate. So that combination of potentially sounder, not sound, but sounder monetary policy with the capacity to appreciate means that I think in the near term, it's not a completely dumb idea to put some of your money in emerging markets, or in emerging market debt, and therefore to enjoy a real yield with the potential of currency appreciation.
Great stuff, Eddie. Thank you so much. Good to talk to you as always, and we'll be back again soon.